Hi, my name's Pete Reinberger, and on behalf of Retirement Services Australia, I'd like to welcome you to Investing for Good Returns in Retirement. At the end of this presentation, I would like to hope that you have an understanding of how you may go about building your own investment portfolio in retirement, normally through a self-managed super fund or using other managed investment portfolios. Or, if not, we'll give you the direction that you need to begin taking the right steps to finding the people who may be able to help you to build your investment strategy for retirement. So please don't take the information in this presentation as advice. It's only for educational purposes. Let's start with what is a good return. So on the screen you'll see that we've actually looked at an investment of $500,000, and with most retirees that we've talked to over the last 30 years, everyone's got a different perspective on what a good return is, and my experience has been that when we talk to people about what a good return is, we'd normally start by saying, well, what are you comfortable with as a return? And the average retiree would say something between 5 and 10% is what they're normally comfortable with. But that doesn't necessarily mean that it's a good return. It just means that it's a return that is within the comfort levels or the risk parameters of the investor that we're talking to. Of course, if I was to tell you that in the last 3 months we made a 20% return for a lot of our retirees on their investment portfolios, you would probably start by saying, well, there must be a lot of risk associated with that. But in reality, in today's presentation, I'm going to show you what we did do for our investors in the last 3 months, and you will find that we actually did make a 20% return for investors in that period of time. So the question about what is a good return is relative. It's relative to time frame, it's relative to the amount of risk you're prepared to take on your investments, relative to the reward that you want, and everybody's perspective is just a little bit different. We've looked at 2%, 5%, 10% and 15% returns over a 1, 3, 7, 15 and 20 year time horizon. It's important for you to remember that as a retiree, if you were to retire at 65, for a lot of retirees their life expectancy is to age 85, and so that's a 20-year investment time frame. So just have a look at that column where we talk about 20 years and you'll see that there's an enormous difference between a 2% return on average after taxes and fees versus a 15% return on average after taxes and fees. And so clearly the difference in the return that you make over time has a material effect and impact on what it is that you can do in your retired life. For those people that are thinking maybe 15% is a little bit, above and beyond what's achievable, what I've got down below is a snapshot of the 5,950 investments that we looked at through our research house who have investment returns for a period of 10 years or more, and we've looked at their performance over 10 years. And what we've then done is just looked at the top quartile, which is the top 25% of the funds in terms of performance that have got 10-year returns, and you'll see there that the average return after fees for 10 years for the top quartile is actually over 10% per annum. And so it is possible to achieve good returns reliably over time. It's just that you've got to make the right decisions about what you're investing in to achieve those returns. There are 3 types of investors in the market. There are advised investors. They're people that receive professional advice from people like stockbrokers, financial planners, accountants, lawyers, real estate agents, mortgage brokers and people like that. There's the DIY set, the do-it-yourself investors. There's a big group of those people in Australia, and I suspect that if you're listening to this presentation you may have an interest in doing your own thing. Our research shows are on average more financially literate and also more highly educated on average than most of the people in Australia, and so these are people that have confidence in their ability to make financial decisions and make investment decisions for themselves. The third category of investor that we come across are the people that are just not advised at all, and sadly for them they normally accumulate a lot less wealth over time than people that are professionally advised. In fact, the research that we've done shows that a non-advised person will actually accumulate 290% less wealth than a professionally advised person over a 15-year period of time, and the difference monetarily to those people and from a lifestyle perspective is enormous. So our advice to most people is to get a little bit of advice and guidance on your way through. It does make a difference. A typical investment strat looks like this. So we've just taken the different risk profiles and given you a guide to what you may look to invest in, what's called a strategic asset allocation for different types of investors. I guess we put a lot of retirees into the middle three sections, which are your cautious, balanced and growth. So if we look at the balanced, you'll see there that there's 65% of the money attributed to growth assets and 35% to defensive assets, which is a fairly standard type of blend of investments for most people. If you're not sure about what your risk profile is or what risk category you should be in, then pop us an email or give us a call and say, can I have some documents that can assist me in identifying what my risk profile should be, and we can give you questionnaires that'll assist in that.